28.
3, 2, 1. All right, here we go.
I can't talk while the thing's not recording.
Because it's recording.
Oh, that's okay.
Yeah. As soon as I start the music, it's going.
That's when it's recorded.
It's going, man.
That's okay. I mean, I can say there's one of 28 slides in the.
Yeah, no, that's not a secret.
Recording. Yeah. I wasn't dropping any bombs or anything.
You guys couldn't see me going, shaking my head.
Yeah.
Don't talk yet.
Yeah.
Don't talk yet.
No, that's all right. It's all right.
We got to cue in the music and slide in sideways. What do you got for us?
Oh, dude, it's almost May.
I think it is. Oh, it's tomorrow's May.
Yeah, tomorrow's May, right? You know what that means?
Go away.
Yes. So go away.
I like to go back to Puerto Rico.
Yes. So would I. Soon, I'm sure. But for this purposes of this show, it is all about seasonality, and there's a lot of talk about go away in May and come back after Labor Day, whatever. Is there anything to it? And if there is something to it, would you bet on it?
Is it a self-fulfilling prophecy?
That could be too, right? But before we get to that, we have a special announcement.
Boom. It's all you.
So 11 years ago, one of my good friends created the Tampa Bay Frogman Swim. The swim raises money for the Navy SEAL Foundation, which does a ton of work to support active and retired SEALs and most especially their families. I've been supporting the swim for the last several years. I was down there this January kayaking in support of the event, and they convinced me to swim the Boston event in June. So this year was the 11th annual swim in Tampa. It'll be the 3rd annual swim in Boston. It's on June 6th. They're doing a big celebration for the 77th anniversary of D-Day. It's been a long time since I've been on the water like this, but it is a 3-ish, when you take into account current and wind, 3-mile ocean swim around Boston Harbor. Water temp should be a balmy low 60s. It's going to be great.
How hard do they really have to twist your arm, Jerry, to go to Boston and swim?
That's where I grew up, right?
Yeah.
So I learned how to swim there, and the water's cold, and I didn't really realize it when I was a kid. I mean, I realized it, but I didn't care. I was just shivering and whatever. Since then I've kind of moved south, and I'm not so used to the water. In the north, it swirls this way. In the south, it swirls that way. It's cold up there.
Yeah.
It's not cold even like California cold. It's cold up there in
Really
Boston.
cold.
Yeah.
I'm going to be impressed if you do it in your UDT shorts.
That won't happen.
No?
No. And I'm wearing fins and a mask, and I don't care who doesn't like it.
Yeah.
So,
as you get older, you don't care.
Yeah, no, I don't care. But I can guarantee you there will be Jameson at the end, 100%.
If I was swimming, it'd be Jameson during it.
I'm not saying there isn't going to be.
Most people would have a snorkel, and I would have just like a line coming in here with Jameson on my helmet.
Yeah, I know. So we got the link in the slide. We're going to put, Conan is going to do his magic and put it up.
We'll put it in the show notes. We'll put it in on Facebook. We'll put it everywhere anybody gets this. Yep. Click the link, and it'll take them to...
It'll take to the page that's here. It's a GoFundMe page. My goal is $2,000. So anybody who can kick in, I would really appreciate it. I definitely need the support. So thanks in advance.
Come on, all you TSP millionaires.
Yeah. Oh, yeah, exactly. All you military, government TSP millionaires.
Slap $150
throw a few bucks in there and watch me freeze my ass off.
Yeah. Only 10 people do it, and you'll be good to go.
Right. Yeah, right.
Yeah, it's a good cause.
It is a good cause. They do a lot of work.
If we're going to be completely transparent, I initially was going to go swim with Jerry, and I thought about buying all the gear, the fins, the suit. Like, first of all, they got to sew 2 suits together to get around, this big tree. And I'm like, no. That's
okay, because we're doing something, a little prep workout for the swim. For me, it's an Army thing, right? This Go Ruck we're doing.
We're doing a ruck march, yeah. That's true.
That's coming up 2 weeks.
All right, man. What kind of market stuff we got to talk about?
Market stuff. So if you heard the very beginning of the show, you're looking at slide 1 of 28. So we're going to go through them relatively as quickly as I think we need to, but it's going to be potentially long, but definitely worth watching. Okay, weekly update show, May 2nd, 2021. So I changed the order of the slides a little bit. We're technical analysts after all. So our most important focus is price. So bottom line up front, what did the price do this week? It was pretty much a consolidation week for the TSP funds. The C fund, more or less flat, was up 0.02%, so flat. Actually, this flat isn't so good because it was a reversal. It closed basically where it opened for the week, but it had been quite a bit higher during the week. So it was a negative reversal, not great, but that follows last week's positive reversal. So I think we're pretty good to go. S fund was down about half a point. That all came today. It's Friday. Was the big down day for the week for the S fund. I fund got hit really hard today also for the week, down almost 1.25 points. F fund is going to be interesting. It'll be the last chart of the slide deck, and it's we've been talking about it for weeks about the Elliott wave theory of it, and it's pretty interesting. So we'll look at it. Okay, seasonality. So the quote, it's an old English saying. It's been around forever. Sell in May and go away, and come on back on St. Leger's Day. So the saying refers to a custom of aristocrats, merchants, bankers, basically rich people who would leave the city of London and escape to the countryside during the hot summer months. St. Leger's Day refers to St. Leger's Stakes, which is a thoroughbred horse race, a series actually, held in mid-September, and the last leg of the series is the British Triple Crown. So it translates to us basically as sort of Memorial Day to Labor Day. That's the saying. So we'll take a look at what the reality is over different time frames and how we use this information. Okay, so what we're going to do is take a look at what seasonal trading actually is. I got two pretty interesting slides that show the trends in seasonality, and then we're going to go year by year for the past 10 years, the season that we're coming into. So I did 10 one-year charts, and we're going to look at basically from the middle of April to the middle of October, and because that's what we now look at as the season that is much more volatile or likely to have uptrends than the winter months. Okay, and then we'll go through the daily charts. Okay, so this is from the introduction. This is from StockCharts.com. This whole slide, and if you go to StockCharts.com and you look in the investor, it's not toolbox, it's education kit, whatever they call it, and you search for seasonality, this is what you'll get. So seasonality is the tendency for securities to perform better during some periods and worse during others. So it's not, we can use seasonality in a whole bunch of different ways and different time frames. It's not just sell in May and go away.
May to September. That's
right.
just like a kind of an older
yeah.
version of it, but it could be days, weeks, months.
Yes, definitely. So there's some back and forth on Facebook in the last couple of weeks about the last 2 weeks of April is usually, seasonally bad, right? Mm-hmm. I mean, we'll give a plug to the seasonal strategies guys. Mm-hmm. There's a group on Facebook that does their whole thing is based on seasonal strategies. Sometimes it works, mm-hmm. and sometimes it doesn't. And I'm gonna talk about how I incorporate seasonal strategies into my sort of technical analysis.
Backing it up with technical analysis.
Yeah. It's actually the other way. It's
other way around.
Yeah.
I guess I was thinking it from their perspective.
From their perspective, and they probably do that.
Yeah, and if they were, if you were a seasonal guy or gal and you use technical analysis to kind of backstop.
Sure. I mean, all this stuff works together, and it's just what you think, what your tendency or your bias is towards, which tool you use.
And we've talked about this a lot lately, where we say we're technical analysts. That's really the foundation.
Right.
It's not that we don't think about seasonal strategies, not that we don't think about fundamental analysis. Just the fundamental come from is technical analysis first,
right,
and then looking at these other tools, kind of as a backstop.
Exactly. So the periods can be weeks, months, years. So for example, Yale Hirsch, we've talked about him before. He was he created the Stock Traders Almanac, and he discovered this 6-month seasonal pattern. Since the 1950s, the best 6-month period for the S&P 500 extends from November to April. So it says since the 1950s. I don't know how old this paragraph is. The last 10 years sort of bucks that thing from the 1950s. So we got a couple of slides about that. So, of course, by extension, the worst 6-month period runs from May to October, which is where you get the saying from. So stockcharts.com offers a seasonality tool that chartists can use to identify monthly seasonal patterns. I would definitely go and take a look at that tool because it's pretty good on stock charts. Okay. So the last slide was actually the introduction paragraph to this thing, and this is actually the sort of the conclusion to it. So seasonality is a tool that gives chartists a historical perspective on performance tendencies. Okay. Even though past performance doesn't guarantee future performance, chartists can use these seasonal patterns to increase their edge. The word edge to me means bias. So I'm gonna talk about it in terms of how does it affect my bias. Chartists can look for bullish setups when seasonal patterns are strongly bullish and bearish setups when seasonal patterns are strongly bearish, which sort of is exactly how I use it. As with all indicators and technical analysis tools, seasonal charts should be used in conjunction with other analysis techniques, which is what we just talked about. Okay. So I got 2 pretty good charts here about seasonality trends. So I sort of stole this one from topdowncharts.com. We'll give them credit, and hopefully they don't come back and yell at us later. So in the last slide, they said Yale Hirsch, Stock Traders Almanac, said that since 1950, right, the best 6-month period. This chart goes from 1964 to 2015. It's a long time frame, and it's a pretty good visual chart because it's showing the average return over those months. So for January, the average return is a little over 1% on average over all those years, right? February, usually not a great month, but positive. March and April are really good. October, November, December are really good. But when you get to May through September, it's not great. A lot of things happen in September for whatever reason. And we'll take a look at it in the charts going forward. But anyway, this is a pretty good visual of a long-term. It's not a trend. It's the averages. So we got to kind of remember what we're thinking about, what we're seeing.
So what's the difference between averages and trend?
This is a month-by-month mathematical average of the gain or losses. It's not a trend. It's not a price trend. It's not a price trend. I'm sure some statisticians could explain this a little better, but it's not something that I would try to draw a trend line or put a moving average on and do it that way. I mean, if you look at January and or say April, April is by the average, it's the highest producing month of the year. It doesn't mean every April you're going to make money.
Right.
So, and yeah, if you broke it down, is it the first 2 weeks of April that on average you make the majority of those gains? Is it the first, are there individual days in April where on average those are the days that people use seasonality in all kinds of ways. The seasonality, the guys that do the seasonality site, you can get all kinds of different things, literally to the day like that. They'll say reallocate on this day, and it's based on this kind of stuff. The historical averages, 9 times out of 10 it happens. If it happens for you that year, awesome, you win. If it doesn't happen for you that year, that could have represented the majority of that strategy for the whole year. And then what are you going to do? So there are pros and cons to all this stuff, right? Lots of ways to play the game. We always say that. Okay, so if you looked at this chart and very simply you said, okay, I don't want to mess with fundamental analysis, technical analysis, anything. What I'm going to do based on looking at this chart, is I'm going to go away in May and come back on October 1st. And you probably do pretty well.
And you do decent, yeah. Far better than you would if you just did,
buy and hold in the C fund for the
or L fund, right?
Yeah. Anyway,
this actually takes into account what the market's doing, not what time you're retiring, right?
Right. That's true. Yeah.
So in my view, and I've actually talked to people about this here recently, where they're just like, yeah, man, I can't get into this whole paying attention to it and whatever. And I'm like, well, the simplest version of the strategy that we try to talk about is this one. And like, you know what? If all things considered, just go to G in here and go. Now, I'm not saying you're going to have great returns, because you still have a lot of risk. You still have a lot. Anyway, point is like, it's a way. And I've started to get a lot more. I don't know if insight's the right word. Historical perspective is probably the right way to put it. Reading that book we talked about several times here on the show. I just forgot what it's called. Memoirs of a Stock
Trader. Yes. Yeah.
So anyway, the point is you go back like the original quote is from way back. Point is it just makes sense because people stopped working, stopped focusing on the market because they were like, I'm taking the summer off. Right. That's right. So it wasn't so much that anything really changed other than the supply and demand was highly affected by the fact that a lot of people that would be trading just said, I'm taking the summer off.
Yeah. It's pretty much true. And to be honest,
if that happened nowadays, I would really buy into this strategy. Like if we were still in those days where you and I want to do this lifestyle. We want to like go north, in May.
Right.
In
the summer
in May and come and go south in September, and that would kind of be the rule if you took all that time off when you were up north.
Right.
And nowadays we don't have to take time off. We got the internet. Like those guys, they got on a boat and sailed across the ocean, and they had no access to the market, so they were like, got to get out. And so you take that many people out of playing in the market, well, that's obvious what's going to happen.
Right. And it's interesting because it has nothing to do with earnings and any other fundamental things.
Nothing. So, this part doesn't.
This part doesn't. Yeah. Okay. So that's that slide. This one, as I was Googling what I was going to put together for this part of the slide deck, this chart also came up, and it answers a question that I wanted to get to last week, but we didn't have time. It was the what's the VIX and how does it apply and all that. So some super smart guys at the Chicago Board of Exchange, right? The CBOE, Chicago Board of Exchange. They trade futures contracts there, not stocks, right? Stocks are traded on Wall Street and around the world, but the Chicago Board of Exchange does futures trading. So they created this real-time volatility index called the VIX. So the VIX represents the market's expectations for the relative strength in the near-term price changes of the S&P 500. So the VIX represents the market's expectations, right? It's futures trading, so they bet on what's going to happen in the future. Expectations for the relative strength of near-term price changes in the S&P 500, which for us is the C fund, right?
When they're saying near-term, we're talking like within a year?
What it does is it's derived from the SPX index options with near-term expiration dates. So it generates a volatility that's
within a few months.
30 days forward.
Oh, a month.
Yeah, 30 days. So they're short-term options. Okay. So what that does, it's the volatility is a measure of how fast price changes. And basically it's used as a way to measure fear in the market. So it's looking forward 30 days, and it's trying to anticipate how volatile, essentially, the market's going to be in advance so that they can buy futures contracts on that volatility. It's a great, it's one of the most used indicators in the world. And so when you're looking at the chart, the VIX doesn't exactly correlate with the inverse of the S&P 500, right? But it's kind of close. When the VIX turns up, you definitely want to watch out. And again, this is the chart of the average daily returns for the S&P 500 is the black line, and the average level of the VIX is the red line, but it's from 1990 to 2017. Okay, so it's not what's happening this year. It's similar to the last chart in that month to month, even though this chart is showing it as a price chart, it's kind of more going month to month, and the average over those months from 1990 to 2017. All right, but there's a couple really interesting things in here. For the most part, you can see when the VIX is going down, right, it means fear is decreasing. The volatility is decreasing in the market, which is consistent with price increasing, right? If people aren't afraid in the market goes up. That makes sense. What's interesting is when you get a change in the direction in the VIX. So right here in July, you had a bottom, right? This bottom later in July was a little bit higher. It was basically a double bottom there. But at the same time, you had a higher high than this high, right? Because these correspond. So when the VIX turned essentially up, because that bottom didn't go lower than this one, it means the VIX is turning up. So it was a leading indicator, right? Because even though the price is still going up here, when the VIX goes up, the price comes down. So the VIX led, and it showed that the S&P was getting ready to turn over, which it did. And so the price didn't fall very much, right? The VIX, the fear gauge went up quite a bit, but the price didn't actually fall that much. That's fine.
I mean, it looks more like a consolidation phase than a...
Yeah.
It's kind of going sideways more than it is down. I mean, it is going
price.
down.
Yeah, price, right. It doesn't... So VIX doesn't mean... and none of these indicators mean
right.
that price is going to do anything.
It's one of many things, always.
Yeah. So then we get another, sort of conjunction point right there, right? You get a low in October there on the S&P, and you get a high on the VIX. Then VIX turned down really hard. I don't remember. Well, it's not that I don't remember. It's because this is the average. So the average in October, which I think is interesting. In October, the average fear gauge turned down a lot, which made the average price go up. So a couple things here. Now that we get the idea of price and the VIX. Back here we talked about how from 1964 to 2015, January to April are the big months, and October to December are the big months, right? This is from 1990 to 2017. We're generally talking about April to May to October. That's not a huge down move in price,
right?
On average, since from 1990 to 2017.
In that picture, it would look like it's going sideways.
Yeah,
it's not really going up and down. It's
more or less sideways,
jiggling around.
At a minimum, the average price of the S&P 500 was definitely going higher through late June, early July, right? And then July to September, October, started trickling off. But it doesn't look like that. Right? Statistics are what they are, right? You can make them look like a lot of things. This is more current, I would say, from 1990 to 2017 is a little more current than 64 to 2015. And it doesn't necessarily portend the future, but it's interesting. Okay. So with that as the backdrop, if we look at the last 10 years, that's what we're going to kind of go to next. So I've had a ton of questions about my order of importance with respect to the tools I use when looking at the charts, exactly like what we were talking about before. So my number one, the number one thing that I look at is patterns, right? Long term first, and then the short term patterns. Probably my second is moving average lines and trend lines, My third is definitely how price is confirmed or not by the technical indicators, RSI, MACD, Williams percent R, and some of the other ones that I use. Seasonality is not at the top of my list, but it does affect my bias, which I was kind of talking about before. So, for example, if I'm long in the market like I am right now, right, 100% S, my bias over the next few months is going to be bearish because we know we're going into a seasonally difficult period for the market, right? I'm more likely to reallocate out of the stock fund sooner than I would in the winter months. But I'd give it a little bit more room to play out in the winter than I would in the summer. But the pattern and price definitely is what always drives the decision.
You definitely take seasonality into consideration.
Yes.
Just not as high up in the list as some other indicators.
It's not the primary.
Yeah. And just to run through those top three things that you said, can you go through that? Because I think it's important for folks to not just kind of glaze past that, right?
Sure. Yeah.
And not that you want to make yours that way, anybody listening, but this is kind of the way, Jerry would be my charting mentor. He's had charting mentors. We follow people that would be kind of higher on the hierarchy of charting mentors, AKA, JC, people like that. Yep. And you kind of want to have that. Like if you really get interested in this stuff, even if it's just in a small way, you kind of want to have like, hey, I understand this one. I don't understand this one. Well, go with the one you understand.
Yeah,
right?
Absolutely.
For sure. So if certain indicators are just speak more to you, right, those are the ones you want to use. So if you could hit those again real quick, what's your top?
No, so for me, like price is everything, right?
Yeah.
In technical analysis, price.
But you went long term, short term.
So patterns.
That would be more of a top down approach.
It's definitely top down. So we've done it a ton of times on the show, right? I look at a 30-year chart of the S&P 500, mm-hmm, right? You get 2007 top, 2009 low, 2000 top, 2003 low, 2007 top, 2009 low. And then the 2009 low to now is the fifth wave that we're in. I mean, we talk about it all the time. That's a 30-year chart, right? And then you bring that down to like the 2009 to now. Just look at that piece as the 1, 2, 3, 4, 5. And then you bring that down to wherever the low. I usually go back to November of last year, the new administration, because that was the beginning of the current like 5 of 5 leg that I think we're in right now.
And what we're talking about right now for folks to get a grasp of is, so Jerry uses the Elliott wave, yep, the patterns of 5, right, that we've talked about before, and you can go look up basically to start focusing in on whatever time frame we're in right now, right. Which is, I think, is really important to understand. For me, I can't see Elliott wave patterns as fast as Jerry can because he's been doing it for years, yep, decades. But they're still there. Like I can't pinpoint them as well, but I can see that, right? And so taking that and going in, and then go ahead.
Right. So you bring the patterns in, which is the pattern of price. The price movement is what's making that, right? Then you're looking at volume of the how much volume there is behind
right,
the
and
price
that's the charts we show down at the bottom. It shows volume.
Right. And then we have the moving average lines. And if you draw trend lines, we do that periodically. We've spent more time along moving average lines more than trend lines recently, but moving average lines and trend lines. And then the technical indicators are at the bottom of these charts. The MACD, relative strength, are the two that I use the most. And those I kind of use to support the price movement with respect to the moving average lines, if that makes sense. Yeah. And then so you take all that and you look at the environment that you're actually in right now.
Context.
Yeah, and in this case, I'm talking about seasonality, right? It could be earnings season. It could be like we're in the middle of earnings season. Here's the technical side of it, but we know that Facebook's going to announce tomorrow and Microsoft and blah, right? So.
And some people might look at that completely
the
reversed,
other way. Yeah.
Right? They would start with the news and fundamentals, right, and move the other way.
Yes.
And it might work just as well. We wouldn't tend to agree with that, but it's okay, right?
Yeah.
I think what I'm trying to kind of pull out of this is that find the ones that speak to you if you're watching this, and start really. So instead of like Jerry just went through like 7 or something, right? find your top 2 or 3 and start learning those. And don't worry about because there's literally, if you do a drop down menu on
50.
stock chart, right?
There are
And
50.
If you go think or swim, I think it turns into
500.
it turns into 500 because each one of them has a variation of the other, right? And you can get overwhelmed.
Yeah.
At least, and from my newbie kind of perspective of only doing this for a few years is okay, just focus on a few. It's just like learning a sport or focus on the fundamentals.
Yep.
Choose your fundamentals. Do you want to be a really good dribbler? You can't be everything.
Right.
Right.
That's right.
So, it took Jerry, 30 years to get to where he's.
Are you calling me an old guy?
No.
My birthday's tomorrow.
Banging through this stuff. I know. I was going to give you a happy birthday shout out at the end.
All right. You can do that
took it away. Pick your core things and start getting good at them. Right. Yep. For me right now, I've gone back into trying to dig my head into Elliott Wave because it is difficult to do. But the reason it's difficult is you just have to look at it a lot and get used to seeing the patterns. And I know that, so you have to put the work in. I was telling Jerry the other day, I think a lot of the reason why people kind of poo-poo technical analysis is because it's hard.
Yeah.
Like, it's easy to just say, it's not easy.
No,
so it's way easier for me to watch CNBC and rattle off what they say about fundamentals and go, well, that's why. Well, that's just because somebody else told you that, or whatever, right? The point is this isn't easy, but it is if you put a little effort in. I think any government employee or military person, if you wrap your head around that, we all have had to deal with it. We all have had to build our skill sets within our job, our profession. This is just one of those things. It's just, make this part of your hobby. You don't have to become a charting expert.
Definitely not.
I will never be a charting expert, right? No. Jerry is as close as it gets as far as, in our little sphere of going in that direction. But I want to know enough where if I couldn't call Jerry that day, I could figure it out. And you guys and gals watching can do exactly the same thing. Yep. And that's really what our purpose behind all of this is educate you enough that you can check in with us every once in a while, once a week, with like what we're doing right now. But what we would be doing right now is kind of validating what you've already kind of seen. And so you come to the show and you go, all right, this is what I saw this week. What'd you guys see?
Yeah, exactly.
And that's kind of the way we hope you approach this is like this analysis we're doing. Like you just say, okay, I've been watching it and I think this and I'm, a little unsure, blah, blah, blah. And then, we get on here and you go, oh, yeah, okay. Oh, but I missed that.
Yeah.
Right? Yeah. That's what this is all about.
Yeah. I do see that kind of feedback on Facebook sometimes.
We're getting there.
Yeah.
We're getting there. And what's great is, although we've been doing this for a long time, we've only really been reaching out, communicating like this for a year, barely a year. And so I'm really happy with the response so far. We've just got to get better at kind of compartmentalizing the communication.
Yeah.
Because we tend to get distracted by some things that we're doing. And it's like, let's stay with our fundamentals. Right. And this is what we do, and this is not what we do. And if you want to go that direction, we can't absorb that, right? With 10,000 people.
Right.
So all right, back to the slides.
Okay. So as we go through the slides, right? Again, a lot of talk in the last month or so about seasonality, and I think people are already starting to form biases where they're trying to fit the seasonality into the chart as opposed to looking at the chart, seeing what's happening in context of seasonality, right? So what I'm saying is as we go through these, don't try to see confirmation bias. Don't try to see in the chart something that's going to confirm what you think should happen because of seasonality, right? Okay. 2011. In 2011, May was the high. May 1st basically was the high for the year. Okay. So it definitely fits with the go away in May and come back after Labor Day because October was the low. So awesome. The seasonality thing worked. And how would we have used that back in 2011? Anybody who's been watching, if you're a subscriber, if you're just reading the newsletters or whatever, so the red line is the 10-day moving average line. The blue line is the 50-day moving average line. You can't really see what's happening back here, but we broke below the 50. Okay. This low was higher than that low, so you're still good. This high is higher than that high. You're good. You get this high. The volatility here between the 10 and the 50, you might ride it, right? But based on seasonality, you say, okay, if I'm more biased to get out during the summer season. So when you get to this low, and then this high is lower than this high, and it comes back down, at this point, I would sell. So hopefully that makes sense. So that's a combination of basically technical analysis and seasonality. So I'm letting it ride like this. If you drew a trend line, right here it broke my trend line, and I want to confirm that it broke the 50-day right there. That's where I would get out. As my line in the sand, that would have been it. Then as the year goes on, you get this high, lower than that high, and then you have this big drop off. So I don't remember what I did back in 11, but my first absolute line in the sand would have been here. Even if I'd have gotten in when it got back above the 50 here, get rid of these. Even if I had gotten back in, which I probably would have, when it got back above the 50 here, I absolutely would have gotten back out here. So I don't think there's any way I would have absorbed this loss. But I don't remember what happened back then. So, and then, you have a whole lot of volatility in here, but it basically went sideways until October and then started back up, which is consistent with the seasonality thing. And if you just went straight out with the seasonality play in 2011, you got out on May 1st at the very top, you got back in after Labor Day, October 1st at the very bottom, and you were an absolute rock star. So seasonality worked out really good in 2011. Okay.
But my question would be, could you count on it?
Well, as we go through the next 9 years out of the 10, we'll see. In 2012, we had a nice run up here and a high the beginning of April. So is April, now we know we had a high because we can see the rest of the chart. You could have gotten out here when it broke through the 10-day. If you didn't, and you let it ride down to the 50-day and consolidated there, when this high was lower than this high and it broke through the 50-day right there, that's an absolute get out. So again, it's consistent with seasonality at that point. If you were, at least from the technical analysis application of seasonality, at the latest, I would have gotten out right there. And it's a pretty big down day, but that's what it is. You would have, not taken in this whole loss, but it would have looked bad on the day that you did it. But then, so this is great up here, beginning of the bearish season, the market went lower. But then in June, which is still early in the bearish season, the market bottomed. So again, if you're a technical analysis guy, what do you see in this chart? I'm not going to put you on the spot.
Opportunity. That's what I would call it.
So here's what I see in terms of the opportunity. 1, 2, 3, 4, 5.
Yeah.
Right?
I mean, I was really looking at that bottom up to the next, next time it crossed way up above the
up here?
50. Yeah.
So if you're looking at the seasonality, you're saying, okay, I did really well. I got out here at the early part of the summer, but now I got a very clear 1, 2, 3, 4, 5. So I just completed a 5-wave Elliott wave pattern, and it completed at the beginning of June. And then now I'm back here up above the 10-day moving average. If I'm a seasonality guy, I'm staying out. If that's what I'm doing, I'm staying out because I don't care.
Right.
If I'm a technical analysis guy, I'm looking at it and I'm saying, okay, my primary tool is technical analysis and pattern recognition. I'm getting back in here. I might not, during the summer, or during the winter rather, if we had a breakdown and it was on like, say we were doing a breakdown in March and it was the beginning of April and we're right here. April is traditionally the best month of the year. So if I had seen a 1, 2, 3, 4, 5 pattern that ended at like on April 1st, that would be really consistent with the time to get in, because it would be the bottom of an Elliott wave and the beginning of the best month historically of the year. So that would be great. But in this case, you got the 5 waves down that hits pretty early in the summer. So for me, where technical analysis is the primary, I would be getting in. I never do it at the bottom. I would have gotten in like right there. Middle of June.
Yeah, because it would take that long to confirm it.
Yeah, that's the confirmation for me for the middle of June.
Yeah, you'd be guessing if you did it before that.
Yeah. And now again, if we were not in TSP, I definitely would have gotten in. Basically, the 5th wave is confirmed once you get past the bottom of the floor. So anywhere in here, you could get in.
Yeah, and so that's outside of our rule set.
For TSP, it's outside the rule set.
If we were playing in an IRA, heck yeah.
Completely different.
Because you could jump right back out.
Right. So, okay, so then what happens? June, it's supposed to be sell in May and go away. In this case, if we sold in May, great. You did not get this loss, so that's awesome. But you also didn't get the gain that went all the way from June to October, right? So this whole gain from a seasonality perspective is sort of outside. It shouldn't be there. And then in October and November, when there's supposed to be good months, you have a decline. So, I guess this is 50-50, 2012. You had if you got out from the seasonality perspective in April, May, you avoided this loss, but you also would not have gotten this gain. And you wouldn't have anticipated this loss, because this is when, you're supposed to be getting back in here. So again, seasonality is useful, but it's definitely not at the top of my list. I think I would have gotten hurt in 2012 if I had just done the seasonality strategy. 2013, just from looking at the chart, I mean, it's a really pretty consistent channel. I mean, you can pick it apart, but from a TSP 2 move a month perspective, there's not a whole lot to work with there. You got a high in May. So if you had sold here and gone away and came back in October, I mean, you're basically flat. So I guess it's not that bad. If you had sold here and you came back in October, bought back in here, you were good. So you got these gains. It was flat during the summer, and the gains started again. So I guess that's pretty good. From a seasonality perspective, if you didn't look at anything else, it would have pretty much worked in 2013. 2014, your run-up goes... So February was a low. And then you get a pretty good run-up all the way through the summer, all the way to the middle of September. You get into the middle of September, and you're saying, okay, I guess we didn't, take the loss during the summer, and I'm getting in after Labor Day, because that's what the seasonality, indicates, and that's the beginning of this big move down. Really, the biggest move down for the year in 2014 was when seasonally the price is supposed to start going higher. It didn't last long. We got a V bottom and it came right back up. But I can't play that game. Like I wouldn't want to take this loss, because the history tells me that it's supposed to not be going down during that time. I can't do it. 2015, we're pretty much flat to up, but more or less flat. all the way through the middle of August and then a complete collapse. So unless you're doing technical analysis here in 2015, I don't know how you're playing this game. The market's super volatile. It's jumping along the 10-day and the 50-day. It would be a very difficult market to play unless you just drew the trend lines. If you draw the trend lines, it's not that bad. As long as you're in that channel, you're good. This would have been a little bit of a fake out, but since this this high was lower than this high, I don't know. I think I certainly would have been out on that day. And even if I missed that day would have been the absolute worst case scenario. But then we have a double bottom. And again, seasonally, we moved higher in October. So, I mean, that's why the averages of these things are important to look at. But on any given year, you just don't know how it's going to play out. 2016, same kind of thing. Pretty good run up until May. And then we had some sideways, right? Little dip into July. I don't know, not much of anything. The move higher was in November. It was the beginning of Trump was 16, right? Yeah, so this was the, I guess this was really the beginning of the move of the new administration, but actually it was this volume right here. That was it. So I would say seasonality didn't well, nothing really came into effect here in 2016. The more interesting thing here, I think, would have been if you looked at the election cycle. There's patterns of election cycles, and this would have been a lot more applicable. 2017, I mean, what are you going to do with that? It was up the whole time. There's nothing you can.
There's nothing seasonal about that.
No. I mean, it just completely took off. Not too much to talk about there. 2018, again, the opposite of seasonality. The problems happened here in the beginning of the year, and then from May to October, we had a huge move. And then from these months that are supposed to be really good, we got clobbered. You would have gotten clobbered in 2018 if you did the seasonal strategy.
So to play devil's advocate for the seasonal
folks
out there.
When I say seasonal strategy, I'm not talking about that guy's website. I'm talking about
exactly.
This sell in May and go away.
And right. That's what we're talking about, is that if you were to take the yearly perspective of seasonality at its most basic thing,
right.
I don't want people to get too confused that we're like bashing seasonality.
No, it's good. I like it.
Because you can squeeze that into different time frames, and these charts would look different. What we're kind of getting at is what I said a little earlier was like, if you just want to, use this as some like the simplest thing, go for it. Well, this kind of proves that wrong. Like, it's not going to work out well for you if you go away in May and come back in Labor Day. Historically speaking, it doesn't really happen that way.
It's like everything else in statistics, right? I mean, and the stats, so you have a 30-year career.
Yeah.
If you come in on day one of your career and you look at the stats and you go, okay, I got 30 more Aprils to go, and the average April return is the biggest for the year.
Right. So 7 out of 30, no, whatever
it is, right? Yeah. So most of them. And if you play your whole career that way, you'd probably do pretty well.
Yeah.
You
do well enough.
Yeah. Well, I mean, you do what you do, right?
Yeah.
Who knows? But as each year that ticks by, it becomes more about the average has less, relates less to you.
Yeah.
Right. I mean, if you flip a coin 100 times and 99 times it lands on heads, what are the odds it's going to land on heads the next time?
50-50.
Exactly.
Yeah.
50-50. Right. Yeah. So, I mean,
every time it's 50-50.
Every time. It doesn't matter.
The average.
The average. Yeah.
Yeah. That's the takeaway, I think, is that, I think if people that are listening to this or have watched this in the past, what we really kind of stress is if you feel good about gambling and you sleep well at night that way, then you can do some of these things that way. But we don't sleep at night. Sleep well at night that way. We want to have a lot more confirmation of the trend and the data, and and not just kind of like wing it and go like, oh, last year I freaking killed it, and I don't say anything next year when I die, and and I've got killed in the market. I don't say anything about it because that's kind of how it can happen, right?
Right. Like this is a good example. 2018. For me, I don't care what seasonality it is. None of it. Fundamentals, any of it. If you have a big run up like this, where we haven't been, so we hit the 50-day moving average right here, but we haven't been below the 50-day moving average, in months. And you get that, like I have to get out. I cannot stay in the market there.
Regardless of what anything else tells us.
Yeah.
Gotta get out.
I mean, I remember 2018. We actually did really, really well during this time frame using our technical analysis methodology because we had a really good 1 ABC for 2 and a 3. And it turned out to be an ABC correction, which was great. And we did really well during that time period. But this is the seasonally the time of the year when the market is supposed to be doing really well. In 2018, you got clobbered. So that's why technical analysis is my number one tool in my toolbox. 2019 actually was similar to one of the, I don't know, maybe 2013 or 14 we were looking at. We had a top in May and a low in October, and basically flat in between. So if you got out here in May, you got back in here in October, you would have gotten all the gains from the beginning of the year. You would not have had to deal with this up and down volatility, and you would have gotten all the gains for the end of the year. So seasonality in 2019 would have worked great. 2020, again, well, 2020 was a pretty unusual year, but all these charts look different. So I can't remember what the chart was, the monthly line chart that we were looking at, but let's just say April we know is the best month of the year. Obviously, April was huge this year because we were coming off the very bottom of COVID in 2020. And then the market ran higher all the way to the beginning of September. So what was really the sort of sideways action that usually happens in the summer happened September to November. And then the market moved higher. So the seasonality sort of shifted a couple of months. But it's still, still more or less worked for 2020. 2021, right? I did this chart yesterday, so Thursday, which is why the C Fund had a really good day on Thursday, but Friday not so much. But this is where we are right now in 2021. So tomorrow is May 1st. Does the market, do something like this for the summer? We'll see. No way of knowing. If you're a seasonality guy and you say, okay, it's May 1st, I'm getting out, you can definitely do that. And whatever happens, happens, and you get back in October, awesome. I would say, from my perspective, so my bias now, like I was talking about before, my bias is to get out of the stock funds at the first reasonable sign of trouble. So for me, because there's such a big percentage move between the 50-day and the 10-day, I don't want to take this loss. It's way too much of a loss for me. So I'm looking really closely at that 10-day moving average and the price. If my bias was like, well, the market's still moving higher and I don't want to get scared out of the market too soon, I would get out below this low. That would be my absolute line in the sand. So say 4,100. A close below 4,100, and then maybe I would look at getting back in if we got support at the 50-day moving average. But that's how I would use this. I would get out early, earlier than I would maybe do in the wintertime. But even at this, I don't want to take this loss. I don't have the percent right now, but it's got to be 5% anyway, and I'm not willing to take that kind of loss. So that's where we are, and we're going to actually talk about that here a second in the 6-month daily charts. So this is where we are in the C fund right now. Again, we're pretty far extended. The 10-day and the 50-day is pretty far apart. And we know we're coming into a rocky season, so a close below the 10-day moving average would probably get me out of the C fund if I was in it. And again, I use the technical indicators to confirm that. The RSI appears to be turning over. The MACD definitely is trending down, and the histogram is below that, is negative, is officially negative now. So I'm not going to give the C fund much more room. That's all I'm going to say about that.
What would we be looking in volume on a given day? So if you saw a kind of a dip, so you tend to look more, not tend to look more, but you also look like during the day, right? Which we don't recommend everybody needs to do. Yeah. You could look at closing day prices and do just well, but because we need to get an alert out by 10:30 or 11 on a given day, you got to be all over it between when it opens and noon somewhere, right? So what would you be looking for? What are you looking for when we're this kind of close, knowing those things you just pointed out? What are we looking for on a given day? And this is more intraday, and I know you can't pull that up so quick, but just kind of in a general sense.
So we had, on Thursday, we had a positive reversal, right? See that candlestick? We hit the 10-day moving average. We opened.
Came back up.
So we opened at the bottom of that square that's at the top. See the little square?
Little bitty one.
Yeah. So we opened.
It's probably hard for you guys to see, but
it's I
it's little bitty.
Pulled it in as much as
that's it. That's okay.
Yes, I can do. We opened just above 4,200. We went a little bit higher, and then came down, hit the 10-day moving average, and then closed the day higher than when we started and higher than 4,200. But on Friday, we gapped down and we opened the day at 4,200, but then went down lower throughout the day.
That's the red one.
That's the red one. Yep, the last one. And finished on the 10-day moving average.
So the one before it, Thursday, it's black because we ended higher than we started.
We ended higher than the previous day.
Red means it started higher.
Red, okay. The red means you closed lower than the previous day. Okay. Red filled in like that means the closing price was lower than the opening price.
So it's both lower. Lower than the previous day and lower than you started that day.
Yes. That's when the box is filled in. On Thursday, it's black.
But not filled in.
Correct. It's white. It's not filled in. It's white. That means the bottom of the box is where the market opened that day. The top of the box is the closing price. Okay, so it's black because it was higher than Wednesday's price. So you could have a red with a white inside, which means you finished the day lower than the previous day, but you finished higher than you opened that day.
Right, which is what's great about candlesticks is they give you all that information in one little thing.
One little picture.
If for some reason that doesn't resonate with you or it's just overload, you don't have to use candlesticks.
Yep.
You can get this out of just like a regular chart, right? And I forgot the name for the other one right this second.
Just closing
price chart, right? So you can get close enough with that.
I look at both because this is like the forest for the trees. Like if you just look at closing day prices, it's way better in a lot of ways. It's way better.
Yeah, but if you're going to have to accept that what just happened today, like if you're using closing day, right, which is what I tend to do earlier on, and then I go, okay, tomorrow, what am I looking for to get me in and out? What's my line in the sand, right? That's kind of what I was getting back with our original question, and you're headed there, which is what are we looking for right now? What's our line in the sand? What would happen there and with volume to make me go,
Because we already talked about all the indicators are leading downward.
Yep.
What happens with the price and volume?
Yep. So we are trying to make a decision before noon to get that day's closing price. We will not know anything about volume. That's okay.
You'll know it the next day.
You'll know it the next day, and it's just the way it is. I mean, if you get out on a big volume down day, the market's probably going to keep going lower. If you get out on a small volume down day, the odds of it turning back against you are, reasonable.
Yeah.
So, but it is what it is. You can't,
Right.
you have to pick a day to get in or out.
And this is really where what I think the takeaway here is. This is when we talk about how you're not going to be able to time that perfectly.
No way.
So I would say it's okay if you wait till the end of the day and you see volumes low and it dropped below the 10-day moving average. That's probably your line in the sand.
So,
right? Not okay, and I'm going to have to accept that I'm getting tomorrow's closing price.
Yeah.
I'm just going to have to accept it. And it may be a little less, it may be whatever it is, but if it dropped below the 10-day, volume is low.
Volume's high.
Volume is high.
Yep.
You
got to get out.
I'm like, yeah, that's it, right?
Yeah.
Now, that because you've really confirmed it, as opposed to looking at the day, you'd go, oh, it dropped below, but I don't know the volume.
Yeah. So as far what you're asking, I'll be back on the slide. So the volume is I can't do the stylus and the zoom in at the same time, but you see the
you can
lines.
back it out, draw, and then back in, or zoom back in.
Do that for a second.
Yeah.
Okay, this is volume, right? So Thursday's reversal day was positive. That's why the line is black. Okay, if price had closed lower, that's negative volume. Okay, so Thursday's positive price move was on big volume. That's a good thing. It's a good thing. Friday's reversal day, right? We basically gave up all the gains from Thursday on Friday, and volume was a little bit less than Thursday's volume. But for me, I'm looking at this and I'm going, okay, the relative strength indicator is rolling over. The MACD lines have crossed and are rolling over. Friday's volume was a little bit less than Thursday's, but not that much less. And the seasonality is telling me that we're going into a rocky time of the year. So when you take all of it together, I'm not giving the C fund much more leeway. And I'll just come out and say it. If you're a subscriber to the site, I would be watching your email on Monday, because if we get a gap down, we're not like, you were asking about volume. We're not going to have it, but we have, Friday's volume. But if we get a gap down here at the beginning of the day, I would absolutely be out of the C fund if I was in it.
Gotcha.
I'm not in the C fund.
Right. We're getting a little in the weeds. Why I'm asking that question is more from a learning perspective, right? Not necessarily trying to guess what Jerry's going to do on Monday.
Yeah.
But here you're sitting on Friday, and these are the things that, like, again, if you pull back from all of this and you get out of the weeds, you could over the weekend, every weekend, go back and look at the charts and kind of set yourself up for the next week. And that could be like your week.
Sure.
Right? It's okay if you have time during the week each day to take a peek. You're going to stand a better chance of staying ahead of it. But let's just say you just don't have time, right? And let's say market closes on Friday, Saturday morning with a cup of coffee, you start taking a look at some of these things.
Yep.
You could set yourself up for the next week for where your lines in the sand are.
Absolutely.
That's a way to approach it. As a matter of fact, a lot of technical analysts will obsessively look at the week, I've seen, but really start making their decisions on Saturday.
On the weekend, yeah.
That's why Saturdays are for the charts,
That's it.
right?
Yep.
Jerry's got a T-shirt.
It must be because there's a T-shirt about it.
Yeah, because everything's done. Like it's done, right? We're not talking about all the things that could happen outside of the market time. We're just talking about our world. It's done. So you could take a look and see what the trends are, kind of put your lines in the sand for next week, and then if that thing happens, execute.
Execute. Exactly right.
And that's why you can get to a point of where I only spend about 10 minutes a day looking at this stuff, because you kind of done the pre-work.
Right.
You set yourself up. I kind of know what's going on. Here's this happens, I'm out, I'm in.
Yep.
Right.
And we only get 3 funds.
So it's really not a lot of work. I always kind of like, I keep pounding on that, because I don't want people to think that what you do is necessary, like, for everyone.
Yeah, absolutely not. Not necessary at all.
I mean, our worlds are way different when it comes to looking at the market, right? And that's okay, because this is what Jerry enjoys doing and loves to do it, and we've found a way to kind of turn that into a positive thing for other people who don't want to do it.
Right. Sure.
Right? Yeah. So if you just absolutely don't have any time for it, watch the alert. If you have a little time, kind of play your game, and then use what we put out to validate that decision, and you're going to be golden. You're going to outperform everybody in your office.
Sure.
Unless they're doing the same thing.
Right. I mean, I would be looking at the C fund, and if really, a lot of times that's all I look at. I mean, now I'm 100% S, but I don't even really look at the S fund in terms of making decisions. I'm looking at the C fund, because not all the time, as we know.
But it drives a lot of it.
Yeah, I mean,
the train.
The funds tend to go up and down together. Mm-hmm. One is always going to go up more than the other on any given day. But the C fund is so broad and important that if the C fund rolls over, everything's rolling over. If the C fund goes higher, we've had a lot of rotation in the market in the last few months, and so the S, which had been leading, is not leading anymore. But it's not like the S is rolling over and the C is going up. It
doesn't really work that way.
No, they kind of go up and down together.
Yeah.
If you get, can you pick which of the 3 is going to go up more than the other 2? I mean, I don't. I haven't in the last couple of months. I mean, whatever.
But if you're playing the TSP game, you just got to focus on 3 things mostly, right? 3 funds. If you're playing outside of the TSP, maybe in the IRA, and we'll say another retirement account, you can do similar game, but you got more choices. Mm-hmm. If you're playing outside of a retirement account completely, and you're just working with a broker and buying different stuff, also it gets way more complicated.
Yeah.
So put it in perspective, right? If you're playing only the TSP game, take these things and apply it to 3 funds, and you're going to be golden. Yeah. If you want to play a little bit outside, or you're already retired, like we are, and we're in the IRA also, well, the great thing about that is there's more options, but guess what? We spend a lot more time looking at other things, right? So the average person that's still in their career is not going to have that time. Yeah. We got nothing better to do. Right, then look at 15 different things. Right. If you're still working and then focus on that. Yeah. Focus on that, and then get better at it. And then that's kind of how I approached it. As long as I've known Jerry, is to kind of when I was on the job, was to focus on the TSP. Really, I didn't a lot. I kind of relied on Jerry's alerts, but as I got more and more time, I did that. And now when I move outside of the retirement, Jerry and I were talking about this earlier. We might even do a show on this where I'm 50, he's 50 something. I'm not going to call you out. I'm okay with telling my age. I got a lot of time left. I don't have to hang it up. And it's so crazy when we hear people talking about retiring. Right. I don't care if I was 60, I wouldn't be hanging it up. Right. I hope to make it to 80 or 90. Yeah. And if that's the case, we got a lot of years to play. Yeah. And actually you can play a lot. I should play, but you can focus on this a lot better once you're retired. Yeah. You might really increase your situation. You get a lot more gains because you got more time to focus. Yeah. So don't call it quits when you retire.
No, definitely not. And the other part of that, because it was off that Gary Vee thing, and I've seen a couple questions about it on Facebook actually. What do I do? I think we should do a show on how do you use TSP to do the things you want to do in retirement, to use it as a tool to live your life.
If you plan on going sitting on the front porch when you're 55, I don't know what to tell you. Like, I hope that you're sitting on the porch, like looking at the market every couple times a day, because because we don't have time to do that when we're in our 20s and 30s and 40s. If we're in the Gov the whole time, or in the military the whole time, we're deployed, we're working, we're doing whatever we're doing, right? But then there's a time when, you got a little extra time on your hands. Yep. Fish, hunt, do whatever,
whatever you do.
But take a few minutes to do this, and you can exponentially build the next 20 years.
You can do it.
But it's not even about building. It's about what you were just saying.
Yeah. So, and I think you definitely use it. Yeah. I mean, that's why you spent 30 years building it. So, don't wait until you're 85 and use it for, to pay for the assisted living home. I mean, you got to have a little bit of that too. But
we're doing both, right? We're living on it and also growing it, which that's
the key.
That's a different way of looking at it. I think a lot of people think I've got to live on it the rest of my life. You can live on it and grow it at the same time.
Well, that's like the rule of 4%, they call it, the rule of 4 or whatever. I mean, theoretically the market always goes up, right? And theoretically it goes up on average 6%. That used to be the number. So if you only take 4% out of your account, then it'll always continue growing.
Right. And you can just infinitely live off that.
So as long as you're, if you have
not always that simple.
It's not that simple.
But if you're actively managing it, it should
be much more than
it can actually be better than that. Yeah, because if you're outperforming that,
that's another whole.
And that's what we're aiming for.
Honestly.
At the end of the day, we're aiming to outperform, the general consensus of how it should work. I don't like to put percentages on it because we don't know what the market's going to do. Right. But generally speaking, we want to outperform what everybody thinks is normal, and continue to live our life, travel, do things, whatever, but continue to build wealth. Because you've got another 20 or 30 years. Yeah. I'd much rather do that than, some of our friends who just are unwilling to leave because they don't know what else to do. Do this.
Sure.
And you'll make more money than you would sitting in the office.
Yeah.
100%. All right. We're close, right?
Yeah, we're getting there.
Are we at the questions or no?
No, not yet. We just did C fund. So S. Let's think about this for a second. I've already done another show because I looked at this chart yesterday, and for whatever reason, it reminded me of 2000. And I don't think I want to talk too much. I don't think I want to spill the beans for the show that we're going to do about it. But what the show is going to be about is basically the anatomy of a topping pattern. So this S fund here is there's a lot of ways to look at it. And I'm going to try to keep my bias out of it. But we had a big run up. We have an ABC correction. This low is higher than that low. You could argue it's, this was an intraday low. This actually was an intraday low also because the closing price was there. So, let me rephrase this. This is a lower low than this. Which is bullish, and the market moved higher. And now, to be expected, we're getting some resistance at the prior high. Okay, so I have no problem with the last 2 days of the market, trickling lower. I have no problem with that at all. We definitely need to see, ideally, like a gap up. And a close up here. That would confirm that we're absolutely in a new leg higher. Until we get that, this is very suspect. I'm not really liking.
We don't like suspects.
No, I'm not liking that RSI is rolling over. It hasn't been able to get to overbought here. I'm not liking that. MACD is rolling over, not anywhere near having made these kinds of highs. Mm-hmm. I'm suspect. I'm still 100% S fund, but I am suspect.
Yeah.
Okay. So while the C fund had a huge distance, percentage-wise, between the 10-day and the 50-day, the S fund does not have that. So I'm looking at. I would be more inclined to get out on a close below that low.
Mm-hmm. Because it would confirm it.
Because it would confirm it. So not so much a close below the 10-day or a close below the 50-day. I'd look at a close below that low to get out.
Like 100%, I'm out. If it hits below there, If it goes below the 50, that might be your line in the sand and say, okay, that's all I'm willing to risk.
Yeah, could be. I mean, we'll see what happens when it gets there. And again, this is just this chart. When you take that also with the C fund, It's going to depend on what the C fund does. If the C fund continues higher and the S fund dribbles down to its 50, I'm not worried about it. If the C fund rolls over and the S fund rolls over and the indicators keep going lower,
yeah, that's it.
And seasonality, obviously, we know is working against us. I'm out.
Deuces.
I fund. Only interesting thing. Well, all right. I fund. The only chart. The only stock of the stock fund that closed below its 10-day moving average. Right. It's not really significant because there's just not that much going on in here. So yeah, it closed below the 10-day, but it's not that big a deal. Pretty big volume. That's not good. RSI's turned lower. MACD crossed and the histogram turned lower. That's not good. But if I owned the I fund, I wouldn't. I'd let it come down to the 50 before I even considered it. The F fund has me completely thrown. So we've been talking for weeks about this. 1, A, B, C for 2. Right, 1, 2, 3, A, B, C. I was expecting this to be 4, and I was expecting the 5 to come down like this. Right? We've been talking about it for a while. We didn't get that. The problem was this crazy day right here when the administration, it was not this past Thursday, but the Thursday before, the administration comes out and says they're going to do some kind of sanctions against Russia for something, and it was going to affect their ability to buy in the financial markets. And it threw this whole thing out of whack. This giant, it went really low. It opened. This is where it opened, and that's where it closed. So it opened way down from the prior day, but then went way back up at some point. And I wasn't watching the news that day. I don't know what happened, but that is one kind of crazy outside day right there. And then the next day, we have another kind of big swing, right? So my final line in the sand was going to be the 50-day moving average line, the blue line, but we're above it. But we're rolling over from it. So is it possible? Here's the bottom line: is it possible that this is a 1, 2, 3, 4, and this is just a 4 that's bigger than I expected? It's possible, but it's getting really big because ordinarily the pattern should look like the length of the 2 and the length of the 4 should be roughly the same, and we're getting outside of the range of that. So I don't know that I would bet against the F fund at this point. I'm not sure what and I don't usually trade the F fund anyway because it's just not worth it. The moves aren't on a percentage basis aren't really worth it.
Right, that's an important thing to point out.
Yeah, I mean if I'm getting out, I'm going to the G because it's 100% safe.
Right, but there has been a couple instances.
There's been times, and it's been.
And it worked for us because we were positive, everything else is negative, but that's the anomaly.
Yeah. So we talked about that a couple of weeks ago. If back here, if that had been the top and the market dribbled down to like May 1st right here, so if this is where we were, I would probably go 100% F.
All in.
Yeah.
Yeah.
But that's not where we are.
Yeah. But that's why we watch all of them.
Yeah.
Right? That's the point.
Yep.
And so you still got to look at everything and know that, okay, it's not a big deal, but this is where we're at.
Yeah. I mean, if you're comfortable the stocks are rolling over, then your only option is F or G. And if you're not sure about the F, then why? Because now it's a cost benefit of the F to the G, and the G is a no-brainer.
Mm-hmm.
You know, so yeah.
Questions.
It
wasn't that long.
Hour and a half, bro.
Hour and 18 minutes on recording time.
All right, non-recording time is an hour and 27 minutes.
Yeah. All right. Well, if you enjoyed the show, please share it with your friends. Hopefully you enjoyed the show. Give us your feedback. Tell us what you like, what you didn't like, what we should do more, do less of. If I should just shut up and run the cameras.
Nah, it's good. You gotta have both.
I try to keep it going.
Yep. It would get awful boring if you had to listen to me by yourself.
Yeah, it's tough.
Boy.
That's why we do. That's
it's
why
tough for
both
me.
of us.
I don't want to listen to myself.
That's why we both do it.
Yep.
All right, guys. Hope you have a great weekend, a great week. You'll be watching this on Sunday evening. We do it every Sunday at 6:30.
Hit the link.
support the
Navy SEAL Foundation.
Yes, we'll get that link in there, and you guys can go. Yeah, give $10, give $100, give $1,000, whatever you can give.
Yeah, whatever.
It's going to a good cause.
It is.
Yep. All right, take care, guys. And with that, I think
Peace.
cue music. Bada bing.